Hi everyone. So today is going to be our 8th lesson for investment analysis. And today onwards, we will be covering one of these main issues, which is called related to taxation and its implication for investment, related to investment analysis. So before anything, um, now I said we are talking about tax. So what is tax? So tax is basically like a financial charge or finance charge which is imposed by a government. And one of the main purposes of the taxation is to finance the government expenditure. It is a government income, and tax system kind of includes collection of tax from the general public or the companies. So it's very important or vital for an organization to kind of like understand the tax system, and it's essential in order to understand like how the taxation works in that particular company, country, and how it affects the organization or the user. So this lesson will basically kind of talk about taxation, the functions, the purpose, types of taxes, and how it impacts and on investment decision making. So taxation, how it affects the investment decision making. So this particular module is investment analysis, and we will be talking more towards how the different types of tax will affect our investment decision. So under the topics that we will probably cover under here would be the functions and the purpose of tax. Obviously, we need to kind of, before talking about how it impacts investment decision, obviously we need to kind of understand what's the purpose of this particular taxation and what are the functions and the different types of taxation. So the first two sections would have those areas, the functions and the purpose of taxation would be one topic. Thereafter, we'll be talking about types of taxation. Then we will move towards the main area, which is the impact on tax on investment decision. And thereafter, we will also be talking a little bit about tax avoidance, tax evasions, how these companies kind of do those kind of things. So we'll be just, trying to understand how things work. So first, we will be talking, this is very important that we kind of understand how the taxation works in order to understand how it affects to any type of decision, right? So first, we are actually starting with the functions and purpose of taxation. So if you talk about the tax system, over the years, each successive government of any type of country would do like necessary changes to the legislation in accordance with their political objective. Basically, it's like this. So any country, when the government comes in, the government would probably change legislation according to their political objectives or policies, right? So this topic will kind of discuss like the economic and social purpose of taxation, and a third kind of like a knowledge and necessity kind of to understand and encourage actually the payment of tax by individual or even the companies in order to contribute towards the economic development. So one of the main purposes is for the students to kind of understand why it is necessary that individuals or companies actually pay their taxes, because it would be contributing towards the economic development. So the purpose of taxation, there are three main purposes. And as you can see, one is the economic purpose, then it would be the social purpose, then it is the environmental purpose. So now let's see how each works. So the first one, as I said, was economic purpose. Now, what is economic purpose? So basically, when the government's net position in terms of like the taxation or even the expenditure will basically have like an effect on the whole UK's economy, right? So the government imposes taxation policies to direct the economic behavior of the businesses. And this is basically is the economic purpose. So basically, so what is economic purpose? Government try to impose taxation in order to make sure that the change the economic behavior of the individuals is called the economic purpose. So now we are going to talk a little bit about the taxation policy. Now, so as opposed to the system that prevailed earlier, which is changing the government taxation policy in response to short-term changes, that is the level of employment, import, export, the government generally favors to long-term planning. This aids in determining proportion of the economy's resources for the private sector after the expenditure of the government. So taxation policies, it depends how, when it comes to like previously, or there was a time when the taxation policies kept on changing a lot. However, it is most of the developed countries kind of have understood that it's very important that certain taxation policies have to be constant, that you cannot keep on changing here and there, and the country need to move on with that sort of policies in order to level of employment, import or exports, because that will help the country kind of move towards, like prosperity. So that is part of the economic purpose, where, economic behavior is kind of measured there. So taxation policies basically direct the economic behavior, and these are basic. The taxation policy will be directed to directed to encourage the individual savings, like offering tax incentives on saving accounts, such as individual savings accounts, or having like tax relief or even pension contributions, and then donations to charities, and entrepreneurs who build their own businesses will get capital gain tax reliefs, and investment in industrial buildings, plant machinery will have capital allowance. In order to encourage, there are different types of individual savings that will be there, like different types of capital allowances, reliefs, as well as gifts. However, to discourage, if the government needs to discourage a particular, so government needs to discourage a particular activity, what they do is they will be imposing more duties, like they'll be imposing fuel duties, like to reduce smoking and alcohol, there will be significant duties on the respective items. In order to reduce environmental pollution, there's taxation such as landfill tax, the climate change levy, and things of that sort. So to encourage, the government gives tax reliefs, and to discourage, there will be more taxation involved. Now, the other purpose that we were talking about is social purpose. Now let's see how this social purpose or the social justice happens. So social justice, the definition, which varies with political belief, is encouraged using taxation policies. So these taxation policies are intended to redistribute income and wealth by directing funds away from the rich to the poor to create a balance in the wealth circulated in a society. So basically what social purpose means, that taxation policies are basically intended with the intended to kind of redistribute the income. So that's why, as you can see, I mentioned that there are tax reliefs given, and there is like more taxation imposed. So this is done where the taxation, there will be more taxation from the people who earn wealth, and then relief will be given to people who who do not, like the people who are not earning enough, and there will be social benefits that will be given to those people, and using those the income will be redistributed. And one of the taxation principles that will be involved is the main taxation principle, which would would be a few things. One would be the progressive taxation, where the income increases, the rate and the amount of tax also increase. So basically, one of the general progressive taxation that we see is the individual income, where generally in any country, there, according to the increase of income, there will be tax slabs or whatever, where the taxation amount will increase. Because obviously when there is more, there are people who earn more, the government believes that they can tax them more and use that money in order to redistribute income, and also to increase the different types of benefits that's given to the society. There is another type of taxation which is called regressive taxation. So basically, when it's regressive taxation, when the income increases, the taxation proportion which is paid would reduce. So if it's like 100,000, and for 100,000 it will be 10%, and when it becomes 200,000 it will be 8%. So the tax paid, the proportion will reduce. And there is another thing called the proportional taxation. So when one's income increases, the proportion of tax remains constant. So that is the proportional taxation. Then the last one would be the ad valorem principle, where the tax based on the value of the product, service, or property on which it is levied. So it depends on the product or whatever service, and accordingly the taxation will be levied. So different taxations have different social effects. The general expectation is that the tax should be equitable or fair to all concerned, and not just one group of people. Which is equitable in this regard is often subjective and depends on the specific scenario. So when it comes to the general expectation is that all the taxation is equal and fair to everyone. However, this what we call as equitable could be subjective, and it also depends on the specific scenario as well. So now let me give you a bit of like few examples for you to kind of understand the taxation principle and different types of taxation. So progressive taxation, I said progressive taxation is when the income increases, the taxation also increases. So the example here is income is a good example of progressive taxation. I mentioned that. For example, a person with an annual income of £20,000 might be entitled to pay 20% of that amount as tax, while another person earning £50,000 or more might be entitled to pay 30% of the amount as tax. So as you can see, when the income increase, when you look at the taxation percentage, it has increased as well. So that's why we call it progressive taxation. So moving on, we are trying to go towards regressive taxation. What is regressive taxation? So tax on liquor remains the same regardless of the income of the consumer, thus taking higher proportions of the income of an individual with a lower income as opposed to an individual with a higher income. So sometimes there are situations where the tax on liquor is, basically when the tax, there is a tax for liquor, there will be a particular amount that is taken in. So when if it's for 100,000, the cost, if, whatever, 10,000 is the amount paid as tax, what happens is that will be divided among all, right? So then what happens is higher proportion of this taxation. So higher proportion will go from a person who has a lower income compared to a person with a higher level income, because it's just, so for every person there will be a specific tax that is given. If it's like 10, I'm just saying, if it's $10, so from everyone it will be the $10 that is being taken in. So for an individual with a lower income, that $10 could be, let's say, from 100. Sorry, so I was talking, so 10 pounds. So say the person earns, say, around 1,000 pounds. So out of 1,000 pounds, 10 pounds is a big amount. However, if it's a person who earns about 50,000 pounds, that 10 pounds is a small percentage, right? So that is regressive taxation, because in the end, when the income increases, the taxation percentage will be less. Now, the next one is called proportional taxation. Now, what is proportional taxation? The tax percentage remains constant, for instance, 10% regardless of the level of income. This is where, specific amount is already given, saying, okay, it doesn't matter of the level of income. So before, in the regressive taxation, it was specific amount. I said 10 pounds in my example. So when it becomes 10 pounds, obviously, proportionately, when you check with your income, there is a difference. However, in a proportional taxation, it is not the amount, it's not $10, it's a percentage, right? It is 10%. So whatever amount that you get, proportionally, you will have to pay. The last one is ad valorem principle. So, so a specific percentage of VAT, so like 20% or 15% is paid on most goods across the country. And that's how it kind of happens, because VAT is a good example for ad valorem, because VAT is generally paid based on that specific percentage based based on the service or the good. Now, moving on, we are talking about environmental factors. So now, environmental factors, the taxation system in the UK is basically evolving, right? So in order to kind of accommodate the significant environmental factors, such as, let's say, the renewable or non-renewable energy, and things such as global warming, many of the taxation policies formulated by the government are in line with the objective that aim towards the environmental conservation. So now all over, not just UK, all over the world, there more preference is given for climate change, because it has become a very important thing that needs to be focused upon. So with time, climate change comes in the new ways of producing energy. So there are like renewable energy sources as well as non-renewable energy sources. So with this, you know, the government try their best to kind of move towards organization, like to tax less for like whatever type of companies who are involved in energy, producing energy which would be environmentally friendly, where they try and give some sort of relief for those. And if it's something that is harmful to the organ, to the environment, then the taxation more, there would be a bigger tax percentage that is being given to those kind of companies. So because looking at the environmental factors and looking at how it affects the environmental and global warming, the taxation will also differ. And now governments are kind of really concerned about environmental factors. So minimization of consumption of non-environmental friendly products. Like basically when there is harmful consumption of non-environmental friendly products, such as like petrol, it is minimized by increasing the tax levied on them, while the use of environmental friendly methods, example, the use of public transport to avoid too much congestion, encouraged by reducing the tax levied on them. So what the government generally does, as I told you, they try and manipulate how people, the economic behavior of people by trying to use tax. So when they feel like, like things such as, which is not environmental friendly, such as petrol is used, for that, the taxation levy is very high. However, when it comes to public transport, they think, okay, using public transport, they don't mean that it's environmentally friendly. However, the amount of harm is reduced. I mean, reduced compared to using one own individual transportation. Therefore, these methods are kind of encouraged by reducing the tax levied on them. So thereafter, now we talked about functions and the purpose of taxation. This is one of like very important section of taxation. And now we will be moving towards different types of taxation methods. So if you look at the if you went through the OTHM module study guide, you would see that these different types of taxations are included there, where you're supposed to kind of understand what these taxations are, what's the difference between these taxation and why they are taxed. Those are things that you need to know. So we will be trying to move on to the types of taxation now. So basically, when it comes to the UK government or any type of government, they raise the revenue through a wide range of taxation, which is administered by the Majesty's Revenue and Customs. And the understanding of different taxation regulations kind of help organization and individuals to identify the tax liability and assist in calculating changeability of taxation. So basically, when it comes to the revenue of the government is basically by tax, as I told you. And there will be tax regulations related to individuals as well as companies. So these will be different types of taxation, which is some would be for individuals, some would be for organizations. So the ones on products will be taken using the organization taxation. Thereafter, so we will first talk about capital and revenue taxes. Now, basically, the government raises revenue from different types of taxes to fund its operation. So basically, the main types of taxes are categorized under capital tax and revenue tax. So first one thing that we need to understand is the government tax come from different types of taxes, right? In order to fund its operation. So as I told you before also, the taxation is one of the main incomes for a government in order to run their operations and in order to contribute towards, causes that they move towards, like try to help other individuals, low income people, and for all these taxes are being used. So the main types of taxes are basically categorized under capital tax and revenue tax. And we'll see how that is being done. Types of capital gain tax charged on capital gain of wealth. So now, as I told you before, okay, as I told you before, there are two main types of taxes. What are those? Capital tax, revenue tax. So first, we will be talking about capital tax. So what do you think capital tax? Looking at it, what do you think? Is it so capital tax is basically the tax of these are obviously taxes related to assets or like some type of asset. So it is very easy to remember because it goes in hand with the accounting definitions of assets. So remember that. And so capital gain tax is mainly based on assets or the capital assets. So basically, when it comes to the capital gain tax, who is borne? It is borne by the individuals, the partnerships, or the companies in the form of corporation tax. So these capital gain tax will be borne by all sorts of people, like the individual, partnerships, and companies. So that means everyone will be involved there when it comes to the capital gain tax. Now, as you can see, we have used kind of like, so we have used a table here where the name of the tax is included and who is borne by is included. Then there is a small explanation to try help you understand what capital gains tax is. So as you can see, capital gains tax, they say payable on the disposal of capital assets, or capital assets include shares, buildings, land, and may also include smaller items such as antiques. So what happens here is that when you sell your assets, okay, they say it says that it's payable on the disposal of capital assets, because what happens in capital gains tax is, there will be a value of your particular capital asset, which is being included in your accounts or anything, things of that sort. So after that, you will be selling this capital asset to a particular price, and there could be a small difference between these two amounts. So you obviously don't sell it to the accounting, amount that you include in your account or, recognize in your company accounts. So obviously there'll be a difference. And here what happens is, if the amount that you sell that particular capital asset is higher than the amount that you bought it or included in your accounts, then there is a tax for the difference, because that is something like a profit for you. From the government's perspective, there is a particular value that you paid, or you included that asset in your accounts. However, now while you're selling it to a higher price. So that means that there will be a small difference between those amounts, and that particular amount will be considered as profit. Something similar to profit, and there will be a capital gains tax. So the reason I use the idea of profit is not because it's a profit, because now when it comes to profit, how do we calculate? We take the income and you take the expense. And if there is a difference where you get something extra to yourself, then that is called as profit. So here also what happens is, you spend some money and you buy something. Okay, that's all you spend on it. And then while you're selling, you sell it to a higher amount. So then obviously, see, you bought it for 10,000, you sell it for 15,000. There is a difference, right? So that difference, you bought it for 10, you paid only 10 to buy it, but when you're selling for 15 pounds, that means there's 5,000 difference, right? So that particular 5,000 is where the capital gains tax will, that 5,000 is what is liable for the capital gains tax. So basically it will obviously include the shares, the buildings, land, the machinery, and even include something such as the antiques, which have higher value. So therefore they will be included as well. Now, thereafter we'll be talking about inheritance tax. No, now when it comes to inheritance tax, it is borne by whom? Could it be companies or partnerships? Inheritance tax are generally borne by individuals, and inheritance tax kind of comes in because when there is some sort of inheritance involved. So when a person in possession of an asset transfers the ownership of it on his death, the executors of such property are liable to pay this tax on the value of the asset. This may also include tax in relation to certain gifts during an individual's lifetime. So whether it's during your lifetime, if you're paying giving up certain gifts free for someone, or you're transferring the ownership after the death, then the property, the holders are kind of liable to pay a tax on the value of the assets to the government, because you're getting it like for free. You're getting as a gift, or you're kind of the ownership of that particular property is just being given to you for free. So therefore, that means it's somewhat like a profit, right? So therefore, the government will be taxing you, and it is called the inheritance tax. Moving on, I will be talking about capital tax a little bit more. So basically, the capital tax is generally charged on capital gain, or wealth and revenue tax is charged on income earned. So I mentioned to you that capital tax will be related to capital gain. Or, there were examples where we were talking about assets being sold at a higher price, or the gain that is being used. So that is what capital tax is all about. And revenue tax is basically on the revenue earned. So it is basically on the profit. So I explained to you that capital gain is something like the profit, but that does not mean that the tax on the profit is also capital tax. You just need to kind of understand. I just took it as an example. You need to kind of understand the difference there. So when the capital tax are charged on capital gain or wealth, it is applicable to capital owned by the entity and not its profitability. So basically, the revenue tax is levied on the income earned by the respective entities. So basically, when it comes to the capital, so basically it would be on the capital gain, as I explained to you, and not on profitability. And when it comes to revenue tax, it will obviously be the profit as well. So when it comes to capital gains, the gains arising as a result of disposal of an investment and other assets are not covered by income tax rules and are not included in trading profit, and capital gain tax attempt to tax those gains. So basically, when we had the example of I told where you buy the machine for £10,000 and then you sell it for £15,000, when there is a difference, obviously it's not taxed price. You're just selling and getting some money. However, you're not taxed for that 5,000. So that's why there is an extra tax called capital gains, where the calculation is there. Now here we are going to have a small example of capital gains tax. So as you can see here, so it says John bought a piece of land at £9,000 and later sold it at £11,000. So the capital gain tax is calculated on the capital gain. So as I told you before, so John bought the land at what amount? £9,000. And then it was sold at £11,000. So what is the difference between those two? So you only spent 9,000. John actually paid 9,000, but John got 11,000. So is it what is the amount John got more than what he spent? So this would obviously be the difference between the two amounts, which is 11,000 and 9,000. So 11,000 minus 9,000, or the difference would be 2,000 pounds. So when it comes to capital gains, I said only the gains will be taxed. So the capital gains tax is calculated for what? Is it calculated for 11,000? No. For 9,000? No. It will be calculated for 2,000, or the amount that John got extra. So basically, when it comes to expenses, expenses are included and we are never taxed by expense, right? So obviously, when John bought that piece of land, he spent 9,000. Even though he got 11,000, he's not taxed for 11 because he has already spent 9 to buy it. Right now, when you're giving the land back, you give the money and the 9,000 is not included. Only the amount that is extra will be included here in order to ensure that the capital gains tax is properly computed. So moving on, we are going to talk a bit more about the inheritance tax. So this is basically because we had everything inside like a table. This is basically a small explanation. So it is easy for you all to understand what each means. So inheritance tax, as I told you, is paid on gifts and transfers, a chargeable person. It transfers something which is chargeable for a person. So it's usually paid on the transfer's estate at the time of the death of its owner. This may lead to a person transferring all their assets just before their death to avoid inheritance tax. To prevent this, inheritance tax has been made applicable to certain transfers made by person during their lifetime. So inheritance tax is tax only at the death. So basically a person dies and then there is an inheritance, and it is, inherited to another person. There is a amount that is being charged from the person who owns it, which is called inheritance tax. So for that, what people try and do is before, because if you transfer something before you die, obviously, then there is no inheritance tax. So because of that, the government is also very careful, because they will be looking at some of the transfer amounts, transfers that a person does during the life as well. Because if someone just tries to kind of transfer everything during the late last period in which he is living, in order to avoid inheritance tax, if the government feels that that's what is being done, they obviously, the government has that opportunity to to make applicable, make the inheritance tax applicable to that particular situation, because they know that that is the reason why this transfer was done right before the death. Then, when it comes to charge to inheritance tax, not all transfers of the asset between persons are chargeable to income tax. Inheritance tax is only charged on a transfer of value of chargeable property made by a chargeable person, whether property transferred or the transferee is chargeable remains highly subjective. So this charge of inheritance tax is between two persons are chargeable to income tax. And the inheritance tax is only charged on transfer value of the chargeable property. And so whether the property transferred or transferable, transferee is chargeable remains highly subjective. So it depends on this whole situation. Because if someone has already died, obviously the one who received it might have to pay. But if it's a situation where a person transfers it right before death and all that, sometimes it might be, it is kind of subjective. So how this inheritance tax works is subjective, we have to say. So now we will look at instances where inheritance tax is charged. So a charge to inheritance tax arises on several situations. One is the death of an individual. So if a person obviously dies and then there is some kind of will where the inheritance is coming to another person, obviously at that instance the inheritance tax charge will come into the person who received that particular land, machinery or whatever that is being received as as a passing away or the death of a particular individual. So lifetime transfers made where the donor dies within the following 7 years after the transfer, also the inheritance tax is charged. So as I told you before, when a person kind of understands, okay, right, the person is going to die, they sometimes try to transfer their assets quickly in order to avoid the inheritance tax. So what is done is a period of 7 years is been looked. Sorry. So 7 years are being used in order to try kind of understand whether the person, did the transfer of assets because he knew in order to avoid the inheritance tax. So certain lifetime gifts which are taxed immediately are also kind of like instance of inheritance tax charge. So accordingly, as you can see, the inheritance tax, what happens is the capital amount is actually being taxed, or whatever is transferred. Sorry, the one that is being transferred is where the taxation kind of happens. Now we will try and see the transfer value or how we can calculate the transfer value. So basically a transfer value is the gratuitous disposition or the gift made by a person which results on the decrease of value of their estate. Like donor is the person who makes the transfer. The person who receives it is named as donee. So for the calculation of transfer of value, the diminution of value principle is kind of used. Now, what is diminution of value? So basically, it is basically the loss of donor principle. So basically, the loss of donor is the difference between the value of donor's estate before the transfer was made, the value of it after the transfer was made, and the loss of donor is the starting point for inheritance tax calculation. Excuse me. Sorry about that. So the calculation of transfer value, as you can see, the value of assets before gift. Before the gift, the value is included. Thereafter, the value of asset after the gift will be reduced from it, and then the diminution in value or transfer value will be calculated. So the asset value before the gift will be there, and then the value after gift will be reduced from the value before gift. And if there is a bit difference, then that is the diminution in value or the transfer of value that is being considered in order to do the calculation for tax. So when the loss to the donor and the gain to the donee are in many cases the same, it is not so all the time. So basically the most common example is not being so with the unquoted shares, where a controlling share has a higher value per share than the minority shareholding. So when it comes to the chargeable property, a gift of any asset is a transfer of value, and there is no exempted assets for inheritance tax purpose. Who are the chargeable persons? So all individuals who are potentially liable to inheritance tax are called chargeable people, and a person domiciled in the UK will be liable to the inheritance tax on their assets which are situated in any part of the world. So basically, for examination purpose, person will always be treated as a domicile in the UK, and the spouses and partners of the civil relationship are chargeable to inheritance tax separately. So the chargeable property will be the gift of any assets or which has a transfer value, and there is no exempt assets when it comes to inheritance tax purposes. All the assets that are being sent down by the inheritance will be taxed as inheritance tax. And when it comes to chargeable purpose, basically all individuals, as I said, is chargeable under inheritance tax, And here we mentioned that we will be including all the people in UK as people who are domiciled in the UK will be included for the purpose of examination. So transfer, now chargeable transfer. Now we need to understand what chargeable transfer is. So any transfer of value that is not covered by an exemption, which is similar to chargeable lifetime transfer or the direct transfer or potentially exempt transfer where donor dies within 7 years after the transfer, they are all called the chargeable transfer. Now, where if I look at a transfer value, we'll cover this. So now let me just, now we were talking about transfer value and you'll wonder what is the transfer value, right? So let me just explain to you using an example. So as you can see in the slide here, they say Berlini owned 60,000 pounds, 60,000 £1 ordinary shares of Caldew Limited, which is an unquoted trading company. So how many shares did he have? Berlini have 60,000, but the value of each ordinary share is £1. So with an issued share capital of how much? 1 share, and which had 100,000 issued share capital. So that means out of 100,000 issued shares, 60,000 was owned by Berlini. So on December 31st, 2012, she gifted 12,000 of the share to her uncle John. The value of shareholding at Caldew Limited on December 31st for inheritance tax purposes are follows. Now, when it comes to up to 25%, it would be £10. If it's, 15 pounds, then the holding should be 26% to 50%. If it's 51% to 74, it will be holding, and 75% or more, it will be 32 pounds. So this is what it says about the taxation. So now let's try and calculate this and try and see how it can be calculated. So as you can see, the transfer of value related to the gift for this unquoted share for inheritance tax purposes as calculated as below. So basically, what did I say? Berlini has how much of share from Caldew Limited? So as I told you, there was 100,000 shares. And out of 100,000 shares, how many shares did Berlini have? She had 60,000. So how many percentage is that? From 100,000, if she has 6,000, that means she has 60% of the share. So she is basically main shareholder of Caldew Limited, as we can see. So Berlini's transfer value, as you can see, is value of estate before transfer, as you can see, is 60,000 into how many pounds? 24 pounds. 60,000, he had how much? 24 pounds, and value estate after transfer would be 40,000 into 15 pounds. So basically 60,000 into 24 pounds would be 1,440,000. And we will be reducing the estate after transfer, which is 40,000 into 15 pounds, which is 600,000. Therefore, the transfer value would be 8,40,000. So 840,000. pounds. So that is how we calculate the transfer value. So we have to talk about different types of revenue taxes. So instead of talking about the revenue taxes, because we need to explain it a little bit more, let me just do the small recap for today so that we can try and remember what we studied, because taxation is also not like a it's not basically an easy area to remember, as you can see. So the topics that we studied were, as I told you, functions and purpose of taxation and types of taxes. So we completed functions and purpose of taxation, and in types of taxation we did certain sections. So we are supposed to do impact on tax on investment decisions and tax avoidance or tax evasion as well. So under function and purpose of taxation, what did we learn? How the taxation system evolved according to the governments, and I explained that there are three main purposes for taxation. They were economic purpose, social purpose, and environmental purpose. So what we did was we were talking about each purpose, where we spoke about economic purpose and how the taxation policy differs according to economic purpose. And we also gave example how taxation policies are used by the government in order to redistribute, whatever comes in as taxation, the money redistribution, where to encourage a certain thing. What the organization did was they give capital allowance, tax, capital gains, or different types of individual cost saving in order to encourage. However, to discourage, what they did was they increased the amount of taxation so that people have to pay more tax. That means it was used to discourage people from buying that particular product or doing whatever it is in the service. So then we talked about social purpose, and in that we spoke about four main taxation principles, where we spoke about progressive taxation, then the regressive taxation, then the proportional taxation, then ad valorem principle. Where thereafter what I did was we were talking about each taxation method using examples for you all to understand how this taxation works. Then we moved on to environmental factors. We kind of see how taxation is kind of used for environmental, to manage environmental factors as well. Then we spoke about types of taxation, where we said there are two main types of taxation, which is the capital tax, then the revenue tax. So today what we covered were the capital tax, where we spoke about capital gain tax, then the inheritance tax. And for both that, so just kind of explain how the capital gains is being calculated. We used an example, a person buying a land and how the capital gains tax will be there. And we even spoke about inheritance tax, how the inheritance tax is charged and things of that sort, and instances of inheritance tax charge. And lastly, we spoke about transfer of value, and also spoke about diminution value principle. And we spoke about how the transfer of value is being calculated, and things like we spoke about chargeable property, chargeable person, chargeable transfer, and things of, concepts of that sort. And that's what we covered for today. And we will be covering the rest of it, which would be the revenue. We did an example. So we will be talking about types of revenue taxes in our next session. And thank you everyone for being with us and for listening to this class. And we've been studying a lot of things, and I hope that you try and understand these things more. And I hope that you understood what I explained to you. And I hope now you have gained a lot of knowledge related to investment analysis, and that it is an interesting topic for y'all or module for y'all to learn. I hope that you have a good day as well. Okay, see you everyone. See you next week with another video. Thank you everyone. See you. Bye.